You're watching inflation, but not just here in the United States, but over in Europe as well. And you believe that could actually impact the market action we're seeing here.
That's right. I'm actually concerned that Fed Chair Powell could be paying attention to the reversion to a rise in inflation that happened in France and also Spain, and looking and saying we don't want that to happen here, which means we have to continue to stay aggressive for longer, as he was trying to back his way away from, I believe, and trying to work our way toward this soft landing that he kept promising. I think we see evidence like that where inflation starts to creep back up and you have to go, maybe we have to increase rates a few more times here, which could be terrible news to the market's ears, as we've all sort of come to consensus around the idea that the market was, the Fed was going to be pausing at least, if not cutting rates toward the back half of the year.
All right, so you're saying rising rates could be a concern, but to be honest, we've seen tech just kind of shake that off. The NASDAQ outperforming, the other indexes so far this year. Do you believe that trend is going to continue? And as someone who's looking at stocks in different sectors, what are the metrics that you're focusing it on? Is it about growth again? Is it about dividends? Is it about margin? I mean, give me a sense of the key metric. I know it's not an umbrella thing, but just one of the big things you're looking for.
So you're right. In January, we did see this moment where all of a sudden the more risky, frothier, dare I say, names that were really the biggest losers of 2022, all of a sudden started to have this resurgence. And then in February, we saw the S&P the last 3 weeks wasn't very good to us. And we saw a lot of those larger growth names start to come back in. I think what investors really have to focus on is just good quality companies that are doing real business and aren't necessarily speculative or just adding AI to the end of their name as a means to add some growth in the short term. And they also are companies that are returning capital to shareholders in the form of either dividends or buybacks or some combination of both. That's really where I think investors should be focusing right now. Otherwise, you might as well hide out in the 6-month treasury and get what, close to 5% in yield.
Yeah, Malcolm, you're not the only person saying that. I do want to get to two of your picks. Both of them are in the cybersecurity space, but also both high valuation names. I'm looking right now at Palo Alto Networks, 47 times forward PE, and then CrowdStrike, 64 times forward PE. At that valuation, why is that so attractive right now?
Yeah, I think that's fair. I think that those two names, not necessarily just based on the technicals, but if you consider where we are in the marketplace right now, I just mentioned the need to focus on companies that are doing real business. And every single time we hear about a major ransomware attack or a data breach at a place like the U.S. Marshal Service and LastPass, whenever these sorts of events tend to make big headlines, it always spells a spike in the share price of names like this. CrowdStrike, I should say, I own already personally, but Palo Alto, I've been watching it for quite some time, waiting for an opportunity for it to come in a little bit. And you just mentioned it. It hasn't really. It's up over 10% since announcing a big earnings beat, which means I could be waiting a while. But the point there is that in this particular case, I think that this is still an attractive place to be looking to deploy some capital, this being cybersecurity, where the rest of tech maybe is seeing a bit of a slowdown. I don't expect these major incidents to slow down in the cybersecurity space, which means spending is going to continue to stay at least flat, if not significantly positive over the next 3, 4, 5 years.